And we are now live here on our YouTube channel. It's our daily show we call the Halftime Report, where we go through these markets one step at a time, breaking down the charts, price action, news, corporate information, economic data, anything that's actually relevant and moving the market that day. I kind of give you some analysis and insight so you can better run your daily routine. And welcome back. Hashtag Team Tackle right in the chat as we're starting our conversation here today on a Thursday. And we got a nice panel for you today. Coach Greg Old Money Holmes is back here for Thursday, and he's got 3 stocks in retail that he's going to be highlighting during his buy one, hold one, and dump one segment a little bit later in the show, where we center around fundamental analysis, and I really have been enjoying that. Greg, how you doing today, sir?
Excellent. Thanks for asking. How you guys doing?
Doing fantastic, man. Thanks for asking right back as well. It's great to have you. And we got Tyler Craig here running screens, going to be doing some of the technical analysis here for us and breaking down markets with us. Ty, how you doing today, sir?
Rally cap today, record highs. You're welcome.
I see the rally cap, young man. Absolutely. Looking sharp, and I like it. And we are at record highs on the S&P and the NASDAQ 100 here today. Matt, you as well. How you doing today, sir?
Doing fantastic. I don't got my rally cap on, but I'm right there with Tyler. I'm rallying, Ty. I'm rallying.
Rallying up, and so is the market. Ty, before we get too far into the market analysis, we're going to go through it. We got a couple of corporate earnings that we're going to look at a little bit later in the show, break down the technicals as markets are hitting into all-time highs. I got some interesting price action in the ARC innovation type stocks. I know Tyler want to talk about that a little bit, and we'll break down all the other corporate news. But before we go down through that, Tyler, can you bring up Tackle Trading and the store page over at Tackle Trading? I just want to kind of highlight something that we're very excited about here. We've been talking about it all week. We released our trading labs, and enrollment started actually on Tuesday for many of our students. We've got a bunch of students, Team Tackle members, already joining the trading labs as a part of what their future educational plans are going to be. I'm excited for it. I think it's an incredible value. I know what people are going to get out of it. If you're out there and you're watching, I'm going to drop a link in the chat again. If you're looking for, the resources to be able to work with a coach on a week-by-week basis with a small group of people in a very focused atmosphere, I think you're going to love the trading labs. And here's the easy part of it, Greg. It's a 15-day trial. So anybody can come and try it out either for one lab or all 3 labs and get a feel for how that works. Tyler, you're going to be starting your trading lab next week. Talk a little bit about this if you can.
Yeah, I've been writing about this every day, and I'm tired of writing about it, Tim. I just want to fast forward to next Wednesday and get this party started. I got big plans. I wrote about it in yesterday's Options Theory blog. We're going to have some fun. You're just going to be able to look over my shoulder, see what I see. You don't have to do what I do, but you're going to see how the secret sauce is made. I'm going to show people how I trade, Tim.
Yeah. Well, and the party actually starts on Monday with Coach Emily. She's going to be holding the first lab. You have your labs on Wednesdays. And what time are your labs, Tyler? I believe 3 p.m. Eastern, right?
3 p.m. Eastern. Yeah, wanted to do it when the market was open so that we could be able to illustrate order entry and getting stuff filled and everything. So it'll be the last hour of the trading session every Wednesday.
Awesome. Very excited about it. And obviously, we also have the Cash Flow Vikings team with Coach Mark. It's real simple, guys. I'm going to drop a link in. You can go get all the information you need about labs. If you have any questions about it, team@tackletrading.com is the best resource you have. Just buzz us an email. We're happy to answer any questions regarding that. Let's get down to the market analysis here, Tyler. Let's start with the technicals here on the charts. You mentioned all-time highs on the S&P 500. We fired back this week. Nice response candle on Monday, extended on Tuesday, doji Wednesday, had the little hump day getting over the week, and now here we are on a Thursday, breaking into a new high. What are you seeing here in the chart technically?
Everything I see, I like. Ain't a thing I don't. I'm actually exaggerating. There are a few things I don't like, but come on, man. We said this yesterday. I did not think we'd be having this conversation last Friday. Did not think this would happen. Shame on me for not believing the buoyancy of the market and the weak sauce nature of sellers. Right back to new highs. I'm impressed. Listen, you can call me a fool if next week we're at new lows, okay? Like you can just straight up do it. I will be flabbergasted if we go right back down. I think this is just a reassertion of buyers being in control here. And I like it. I like it. I love what's going on in the growth area and what's going on in technology. What do you think is going to happen, by the way, if financials go back into an uptrend, if basic materials go back into an uptrend, if industrials go back into an uptrend, if the market can look this good with those cyclicals still being kind of crappy, I mean, maybe I'm getting too far out over my skis here, but I don't know. I foresee good things if those sectors get back into uptrends.
Well, that would be some work they got to do to get back to those states. But you're right, though. I mean, the bull market right now is not about the areas that were in the strength there for a while, Matt. They are coming back up off the lows on the dip last week.
Well,
what's your read on price action?
Let me answer Tyler's question about what would happen if the cyclical areas break out. Your joy in the tech and growth areas would not be as joyous. That's what would happen.
Hey, why can't we all win? Why can't we all win, Matt? Come on.
Yes, let's wait for that hyperinflation to come in and win everybody. But no, I totally get the point, and I don't want to rain anything on this parade going on in the market. I like what's happening in the market with the breakout. You got to like what's happening in discretionary comms. You look at the communications breakout that's literally happening today. You got to like what you're seeing from a technical perspective there as well. But I do think the story of today and what's happening in the market is the continuation of the rotation that we saw or that we've been talking about over the course of the last few weeks now, and that rotation coming out of value, coming out of the cyclical areas of the market, and really attaching themselves into the growth areas of the market. And technology, communications, and quite frankly, discretionary all look really, really good right now, and they look like they're going to continue into the foreseeable future as well until we start to see some technical challenging environments. And specifically on today, and today was maybe for me a little bit more important than other types of market participants out there, because I do put quite a bit of emphasis on kind of these themes in the market that form the top-down approach to the market, really identifying these macro themes that have a tendency to drive markets over time. And last night, there was some very important news that came out regarding Biden's infrastructure plans called the American Jobs Plan. And if you guys will recall, a couple months back, Biden unleashed his $2.25 trillion infrastructure bill that had both what you would consider traditional infrastructure of, ports, bridges, roads, dams, and also what you might consider non-traditional infrastructure, which now is being regarded as the American Families Plan, which would be more in terms of childcare and helping people go out there and getting a job. And so what we're seeing happen right now is we're separating those two discussions. And the news that came out last night, I do think is important. You had a group of, I believe, 11 Republican senators, 10 Democratic senators agree on both the plan for the American Jobs Plan. It's going to come in at $1.2 trillion over 8 years. In that plan, you're really talking traditional infrastructure here. Ports, bridges, dams, roads, but you're also talking about broadband here as well. And so there is an agreement from a bipartisan perspective on an infrastructure bill that would be $1.2 trillion that will go through the traditional lawmaking process that has to achieve 60 senator votes. The bipartisan agreement's going to Biden today. We'll see where that ends up at the end of the day, but we do have a lot of positive momentum from an infrastructure bill coming to America here, and I do think that's positive news. What I don't think is positive is on a day where you actually have a bipartisan agreement to move forward on infrastructure, what's happening in those areas of the market that would primarily benefit from infrastructure, and that's the cyclical areas of the market. Bridges, roads, dams, infrastructure. Well, I think energy, I think basic materials, I think industrials, I think those areas of the market that are driven from a cyclical perspective, like finance. And you look at the price response today, nothing. What happened? They all drove into resistance and got smacked right back down. Whereas where you're seeing the true movement in the market today is similar to what we've been seeing over the last few weeks, and money coming right into the growth, coming right into comms, coming right into technology. And I do think that's very telling in terms of what we've been talking about in this sector rotation, and whether this rotation was something that was real or if it was something that was just the market needed something to do. And quite frankly, after an infrastructure bill like that is announced, you would think these areas of the market that would benefit would be cyclical. They weren't, at least early today, they weren't. Where's the money? Right back into growth. It just gives me a little bit more confidence in the rotation that we've been seeing in the last few weeks and whether or not that can continue into the immediate future. And I say yes now.
Mhm. It's a really interesting set of price action here today in some of those sectors. And Ty, if we can flash at a couple of them here, because obviously when you hear infrastructure, the first thought is probably industrials, right? And then materials and energy and all the ones you talked about, including financials. Matt, little bear retracements are still what I'm seeing in the charts. After the deeper, pullback, we're now rallying back in a little bear retracement, little tight doji. XLI is only up 0.4% here today. So it's a muted price response. But even with XLF, another head scratcher for me on this one is there's even another catalyst for financials today, potentially, and that is going to be the bank stress test that are going to come out after the bell, which they're all going to pass, by the way, which is going to...
that's secondary news, right? But
Yep, for
very
sure.
important. We'll talk about that here in a second.
And probably even tomorrow once we see the price response to that. But you have some potential catalysts that could be moving some of these areas of the market, but the patterns really have not cleared themselves up at all. In fact, still a lot of questions in terms of what these prices are going to do over the next couple of weeks.
Well, and think about it. All of this becomes difficult because support gets broken, right?
Mm-hmm.
And that's how important the identification of support is. Once support is broken, think about the positive catalyst. Just today, you talked about finance, right? You have traditional infrastructure, which definitely would benefit the financial area of the market. You also have news specifically in the financial sector that if these banks pass the stress test, that they're going to open up the coffers again. They're going to start paying out dividend. They're going to start doing aggressive stock buyback programs. And we know how beneficial to price appreciation those two concepts over the last 10 years have been to the financial sector. And yet still, what's playing today for the most part?
Tech,
Comms, and discretionary.
Yeah, it's an interesting, bit of analysis. Tyler, any thoughts on this? Because that is what we're seeing sector-wise in the market, even on the backs of some of this news.
Well, as far as financials go, financials are outperforming the S&P 500. They are up almost 1%, so it's not nothing. The challenge is where they came from into the news today. You had major breakdowns last week. It takes time. It takes time to heal the damage that was done. And one good news cycle, I don't think is sufficient. Whether or not, the narrative is correct today. There's no doubt about it. Whether or not it persists, we'll see. I don't know that I have a strong opinion, to be honest. No, they're not up as much as maybe you'd hope. And their charts they're broken right now. So maybe just what it means is broken charts need time. Broken charts need time. And regardless of what the news says, there's overhead supply. There are bag holders that are stuck because of last week's breakdown. It's going to take a bit of time to chew through that overhead supply.
Matt, any other thoughts on just broad market sectors and the theme here today?
No, even positive news in the face of technical challenging environments. They don't get clean until time passage.
Yeah, I think that's definitely the takeaway from a chart perspective. All right, well, back on the indexes here for a minute there, Tyler, if we can. And obviously, we're talking about broad market sectors and some of the response across many of them. You mentioned the ES breaking into new highs. Matt said some of the strengths in tech. Look at that NASDAQ breaking into new highs as well. It's actually leading the market from that index perspective over the last actually probably month or so. Tyler, what is your read across the other indexes here real quick?
Yeah, I like what I see. It's nice when things that have been working continue to work. So the fact that the NASDAQ is leading today is not a surprise, right? For those that paid attention to what was going on in those growth names, you're being rewarded today for paying attention to that. Small caps also getting it done today, up almost 1%. So like I said yesterday, these were nasty last week, and I love the buoyancy It's like you pushed that beach ball under the water, Tim, and it just came right back up. I like it. I like it actually. Still got some room. Still got some room for a breakout in small caps. But listen, if I'm riding the future, it says, give me a failed bear retracement in finance, basic materials, industrials. Give me those coming along with growth. Give me a breakout in the Russell. And I'm going on vacation. I'm going to stick a fork in it and I'm out of here.
So everything up while Tyler goes on vacation.
Yes.
Yeah, that would be nice.
We will do our job, Tyler, as market participants to make that happen.
Give you your summer vacation the way you want. You never know. It doesn't always work out the way that you plan.
We are going to force every asset class to go up.
Have you seen the movie Vacation with Chevy Chase?
Happened before.
They're not always smooth. Greg, any thoughts on broad markets here before we move into commodities and whatnot? Just technicals, themes, just the trends as well. What are you seeing here?
Yeah, I don't really know what I can add to this. I think you guys are spot on. The markets feel like the little engine that could. It just keeps on moving, or maybe the Energizer Bunny, whatever you want. But I think the rotation is very very easy to see. You know, you look at the tech sector's doing well, comms are doing well. You know, really, I was looking at discretionary today. You know, that's where I picked the picks for buy one, dump one, hold one today. And yeah, you can see that the value has been left behind moving into those kinds of areas. And until further notice, that's really what's going to happen. So, hey, maybe Tyler's right and he gets his wish. He goes on vacation. I don't know. We'll have to see. So,
well, I bet Tyler's going to take a vacation, whether he gets his wish or not. That's the nature of them.
That's why we have stop losses.
That's right. That's right. And portfolio allocation, all those kind of things. But I'm with you guys here. Let's move from broad markets, though, into commodities. Then we got some stock corporate news I want to get to in a little bit as well. Let's start rounding up the commodity markets with crude oil here, Tyler. And not much in the price response here today, just kind of a doji up near the high. You talked about overhead supply, Tyler, and those lines up there, we keep referring to them because when you back it out, you see a lot of overhead supply here on crude. Feels like a really good market to kind of just, you know, work with the trends, maybe cover call kind of stuff. But the health in crude is definitely spilling over to the healthy energy stocks. We're looking at those charts as well. What's your read here on crude oil, Tyler?
It's up 5 weeks in a row. I mean, this is the fifth weekly gain. When you go back, what did you want on the breakout when it popped above 67? You wanted follow through. You got 4 weeks of follow through after the breakout, and it's behaving itself. You know, a good chart breaks one resistance and skips along right to the next one. Couldn't ask for anything more. I think 4 weeks up is great. Look, I will allow crude oil to pause down 0.1% if it wants to. I mean, just give it a rest. It's fine. A little bit of choppy sideways, A-okay with me. Nothing not to like.
Greg, what about you with crude light? Obviously been a very healthy trend. How are you approaching this area of the market? Are you trading crude directly? Do you trade energy companies? Do you got your core holdings? What been your approaches? It's been, you know, in a very, very good uptrend here and now up 5 weeks in a row like Tyler's talking about.
Yeah, so I'm always in the crude space myself. I usually trade the company, the big companies, the Exxons, the Chevrons, those kinds of things. When we get breaks like this, I tend to get a little bit more directional. Typically, I'm cash flow trading those big companies. They're one of my bread and butter. The quality dividend payers with lots of market cap and lots of strength. So that's usually how I play it. I actually will play the futures charts as well. Depends on the time frame that I'm trading in. I think crude's fantastic right now. I like where Tyler's got his lines drawn. I think, you know, you get a push up and then definitely a pause, if not even a small pullback there from that upper level. I did read yesterday, I think it was, that the U.S. was going to reduce by 8 million barrels a day or something to that effect. And of course, that's going to add to the demand part of it, right? If the supply is lessened. So yeah, good news for crude and good news if you're in a trade here. So.
Well, the best argument for crude probably has been just global demand increasing for some time. Those inventory numbers, they're so just shoddy and inconsistent as the way that they report them. So I don't ever get too worked up about weekly inventories anymore. It's been pretty inconsistent for a while. But you got to love what's going on with crude here. Doji here today, not much else to add to it. Let's move on to gold. next here. And gold, after taking one right on the chin here, guys, I mean, it hasn't continued to break down, but that chart has definitely not really improved in my eyes here. Matt, what about you? I'm seeing, hesitation. It's going to have a battle here for support, but not much in price response here this week.
No, I really don't have anything to add on gold. I want to go back to infrastructure, though, because
sure.
Biden just came out and said we have a deal with the bipartisan agreement. So infrastructure does look like it is going to get passed. And you know what? I know the market response is muted in the cyclical areas of the market, but I'm just excited, quite frankly, that we're finally going to have an infrastructure plan. We should have had one a decade ago. We should have had one 5 years ago. I'm just excited that our roads, dams, bridges, and traditional infrastructure is going to be a focus point. I'm glad we're going to have broadband investment into the U.S. so that everybody in the U.S. can get access to the internet. I love everything about that plan, so I'm just a little excited. I've been calling for infrastructure for years. We finally get one. I think it's positive.
Very cool. I love it. I'm seeing this across some of the news wires I track as well. Biden declaring they got a deal, Matt. I appreciate you keeping.
Listen, give credit where credit's due. We're in the world of partisan, and 11 Republican senators, 10 Democratic senators. Biden, a deal maker, comes in and we get a deal.
Mm-hmm.
Give credit where credit's due. I like it for everybody.
Well, and the details on that obviously are going to be ironed out over a little bit, but it sounds like a bipartisan group of leadership is moving this thing forward. So that's
we're going to yell at each other over cost and spending and where money is allocated. Don't get me wrong. I'm just excited in general right now.
Very cool. Yeah, very, very cool.
Yeah, give it time. We'll yell at each other.
All right. Greg, what about you on this gold chart, though? I haven't heard your thoughts on it in a couple weeks.
Since I'm not in the States and this infrastructure bill doesn't mean anything to me personally, I do got to say that an image that just came to mind when Matt was talking about bipartisan. It reminds me of, do you guys remember Crayola crayons? They used to come in the box of like 128 crayons or something, every color under the sun.
When I was a kid, Greg, there was 6. So
I know. Well, it's grown since then.
Yeah.
But anyway, they used to have the big boxes of crayons. So, I remember kids and, basically they just come and they just take all the crayons and some kids would get nothing. It seems like this bipartisan thing, it's like they actually split up the crayons fairly and now they're going to scribble out some details. That's kind of the image that popped in my head. So I don't know. I think that's kind of funny myself. But as for the gold chart here, nothing to see here really. I'm glad that it did hold right at that level, 1740-ish there or 1760, somewhere in that neighborhood. I'm glad it did hold there, but yeah, it's got a lot of work. It's got those overhead moving averages to get by before it starts making any real progress. It's a wait and see kind of thing. From the standpoint of inflation, does that, as we talked about last week, has that issue been solved according to the Fed? That's kind of what the reasoning, I guess, beyond the beatdown was. But I don't know. I think longer term, I still think this goes north. But right now, it's just sitting sideways. So I don't think there's really anything you can do about it.
100%. We're going to be battling the support zone for a while. It's going to take some time. There's quite a few of these charts that are going to take some time. There's other areas like Matt's been highlighting with tech and comms that don't necessarily need time. They're still very healthy, but gold's not one of them right now. Let's move on. Let's keep working through the markets one step at a time here. And let's go on to the dollar next, then Bitcoin. Then we're going to get into stock talk. Got a couple companies in earnings reports that we're going to take a look at. The dollar, Tyler, it rallied last week. The market kind of didn't trust the signals, obviously. There's a lot of mixed messaging, although it is holding up here nicely. You have officially going to be putting in a higher pivot high on a chart pattern like this that fires up off support. What do you watch for from here to give us clarity on the next move in direction? Because I don't think the market really knows where they want to take this dollar, but they did rally it right off that support last week. What's your read here?
Well, and this is coming off of a couple of failed attempts to get off the mat, right? I mean, you had a decent uptrend for a good 6 weeks that ultimately failed. This looks similar quite so far, at least. So I think the depth of the pullback is going to be telling. You don't usually expect this big of a breakout with this much volume to completely fizzle, right? It is completely ordinary to get dip buyers stepping up on the next pullback. So I'm not surprised, but where it's difficult is you have competing timeframes here. The longer term trend still looks bearish. You have a descending 200 MA. It just seems too cute, too clean, too easy for this to just pop right into an uptrend and rip higher. I think it's going to be a battle here between long-term bears, short-term bulls, and that usually translates into a messy, choppy chart.
Yeah, it's messy in my estimation, for quite some time, and I'm not exactly seeing this as a bullish signal that's going to develop into a trend. We got a long ways to go before any of that kind of analysis comes into it. All right, last one here, Bitcoin, Tyler, and it's been trying to battle down here at the bottoms. Obviously, it was reported earlier this week of that famed death cross from so many financial media, firms out there that actually did not happen. So many people were jumping on that false narrative. It did break below 30,000 though, and now we've rallied back 3 days in a row into some congestion. I mean, this chart is still very much messy in my estimation as well, trying to find where that support zone is. We know where the battle lines have been drawn here, 30, sub 30K, around that 29, 28,000 mark as well. We've seen some of those little dojis. What's your read on the chart here as we've rallied 3 days back up into these moving averages?
Yeah, so as I said yesterday and laid out in the tackle today a couple days ago, my working theory is that this is a failed breakdown or breakout, bear breakout, a bear trap. The more this can hold above 30K, the stronger that case becomes. So it's stability is what you need. I think the recurring theme among a lot of these charts is you just need time. When you get beat down as much as Bitcoin did, you need a little bit of time. So I'm pleased that it's holding above support so far. That's what you needed. But is it inspiring? Is it epic? No. It's just holding support. So we just need time. I mean, I hate to keep saying the same thing, but that's what happens when you got a load of broken charts. You just need a little bit of time for this to develop into something more.
Yeah, it does need time. Obviously, you like the first 3 days. If you're a bull, there's still a lot of mess there. And I'm sure even some traders probably, Tyler, could even look at that as a potential little bear flag developing, and a potential breakdown below these support zones would be extremely bearish on a chart perspective. So we got to watch it. We got to wait for the time and those chart price action places to play themselves out and give us clarity on it. All right, guys, that's all I got from market skyline perspective. Let's now move into individual company news during our section we call Stock Talk here today. A couple of companies in the news that grabbed my attention. We also got a few earnings stocks to do a couple of quick roundups on. KB Home reported earnings that I noticed. Darden, Restaurants reported earnings, and Carnival Cruise reported earnings, although they didn't have hardly any revenue because they haven't been cruising. Matt, let's bring you in here next for a couple of these earnings bits of analysis. What grabbed your attention here today, if any of these companies did, but which ones grabbed your attention?
Well, let's first start with Carnival Cruise very quickly. CCL, please, Tyler. Revenue obviously is going to come in very, very light. They haven't been doing their primary business, but the expectation was still 163 million in revenue. That fell woefully short, coming in at 26 million. That resulted in an EPS number that also missed at $1.79 negative versus the expectation of $1.66. The net revenue decline resulted in a year-over-year loss of 99.5% in revenue. It does not get worse than this regarding earnings. Why isn't it down more? I think everybody understands the context over CCL, right? Shut down, hasn't been able to open back up. And unlike other areas of the market that really were pandemic driven, like restaurants and airlines, they've been open up for quite some time now. Cruise lines coming back on slowly. So there is some context there, but still a fairly negative and a more negative report than actually a negative response given the context. I don't have anything else to say on Carnival. Does anybody have anything from a technical perspective?
Well, even outside technicals, I want to go on your comment there about them reopening and everybody understands the context. I think we all do. And, I was looking a little bit into that, Matt. 42 of their 90 ships are expected to start sailing by November. They actually have, I think, like 9 of them that are going to put their first sail out there in the last 15 months, in the next 2 months as well. So Carnival had to do some of this stuff, obviously, just to survive. They took an $11.5 billion balance sheet and they had to chew up $2 billion in cash in the last quarter just to try to get this operation up and running. And can you imagine completely shutting down all operations for an industry for 15 months and getting back up and running? There's context here for sure. but the price response is now leaving me in a feeling very neutral on the chart. It had a nice breakout developing there for a bit. Post earnings stuck in a range. It almost looks like here. So, Tyler, what are you seeing in the chart? Anything that grabbing your attention there?
It ain't pretty, that's for sure. It's too, there's a lot of noise after an earnings announcement. So I don't know if I can pass judgment on today's bar, but if it sticks, you're breaking below the 50-day moving average. That puts it back to the lower end of this trading range potentially. If I had to do something, I don't know what I would. This is a chart I pass on pretty darn quickly.
If you own it, you're writing cover calls, and that's it.
Yeah.
Correct.
Gotcha.
Yep.
Yeah.
All right.
Next, let's move on to Darden. Darden Restaurants here. This is a company that was able to open up a little bit quicker than some of the others in the cruise lines. But Darden reports strong numbers in both EPS and revenue. Darden comes in at $2.03 EPS versus the expectation of $1.82. Revenue came in $200 million above the expectation, $2.3 billion out of $2.1 expectation. That resulted 79.5% revenue increase year over year. They also reaffirmed guidance. And then one of the key metrics we look at in retail is same store sales. That for Darden surged 90% year over year. Real positive numbers coming out of Darden. Price response fairly positive as well. Tyler, what do you see technically here?
Yeah, it's impressive. I mean, it's back up testing the 50-day moving average, testing some overhead resistance levels. It's up a good 4 bars in a row. I mean, it's rallied quite a bit off of the lows here. Best case scenario, it chops a little bit to digest this move. This is tricky though, Matt, because you also have another big resistance level here. It would be cleaner if it would just jump up to 147, take a nap for 2 weeks, and then give me a breakout over the highs.
I'm looking at the weekly chart, Ty, and I just see, excuse me, I just see a little bit of chop and the same type of thing on the daily chart. Even if you break out of this wedge, where are you going?
Yeah.
You know what I mean? So technically, I do feel like it's got challenging resistance levels, and I agree 100%. Darden's a great company. It's a great company. But technically, I think Tyler and I are looking at the same thing. Let's go test that resistance level, right? Let's go test it. And then let's either fade back into support and form a bullish retracement, or let's high base breakout. But let's test that high first.
Well, and there's so many good charts out right now. It's like, why force it? Why force it? Wait for a fat pitch. The other thing that's interesting here, Matt, I was looking at their dividend stuff. So they cut dividends in the pandemic, presumably. They ramped it back up 30 cents, 37, 88. Now they're $1.10. That's higher than where it used to be pre-pandemic. So nice to see they turned the dividend spigot back on relatively quickly after the pandemic.
Yeah, no doubt about that. All positive. Technically, I still think we're all waiting on the same thing, though.
One other thing grabbed my attention in their report. I actually looked through some of it this morning as well. You know, you're talking about the numbers, which they obviously came in and had beaten a beat and good same store sales. Their fine dining segment, Matt, which is, you know, the one that was kind of really slow to get up and running, because even like Olive Garden would have the takeout and the delivery and all those things, right? Over the last year, and they had pretty okay numbers there. Olive Garden had huge same store sales growth for sure, but their fine dining unit, 143% same store sales growth quarter over quarter, as diners are going back to restaurants, sitting down and actually doing those kind of activities as well. I thought it was a good report. I'm interested from a longer term perspective. Good company. I got nothing to add to the chart there, but yeah, some good numbers from my end that I saw.
Yeah, Darden had really good numbers. By the way, coming back to infrastructure deal, guys, go look at the Dow Jones very quickly.
Oh, now I'm typing this ticker in with trepidation. What's it going to be? What's it going to be?
No, look at the daily, not the daily, but look at the intraday, like 15-minute chart.
Oh, gotcha.
Dude, it's starting to move. Starting to pump a little bit. Got to like that industrial news coming into the market.
Hey, I laid out the script 20 minutes ago. Why are you acting surprised?
Listen, and it might play out. Everything might just go up, Tyler. It might just do it. But just wanted to come back to that very quickly. Last earnings here, KB Homes. KB Homes positive numbers on EPS, slight miss on revenue numbers, a little bit of a mixed bag, in my opinion, on KB Homes, but just housing sector in general out of favor right now more than anything. KB Homes came out with $1.50 versus 129 against on the expectation. Decent beat on EPS. Revenue came in slightly under the expectation, came in at 1.4 billion versus the 1.5 expectation. Revenue did result in 57.7% year-over-year increase in revenue. Positive, again, little bit of a mixed bag on their actual raw numbers. One context from some of the numbers I saw, Tim, they had a surge in demand.
Mm-hmm. Yep.
A surge in demand. And so but again, kind of out of favor in general with the market response. I think this market response is a little bit of an overreaction to a mixed bag on their actual data. Just shows you more than anything the housing sector is out of favor.
Just kind of exactly the way I felt about it, because I looked through the numbers, thought about even what they were saying. Like they announced some big new development project in Maricopa, Arizona, which is a huge growth area of the market. They got all these homes that are selling. Average home price, by the way, went up to like 410,000. We've seen that data in the home reports, right? So, I mean,
when you read their raw data and when you go over their earnings report, there's not a lot of negative here. And there's definitely not gap down, sell down 6% negative data here. Yeah, I think it shows you it's out of favor.
Yeah, it feels that way as well. And then that it for earnings for you, Matty?
Yeah, that is it for me for earnings roundup for today. We do have Nike after the bell, though. Nike's a big one. Nike, you know what? There is a lull between Nike and the financial sector, but Nike's the one that really kind of starts it for the next season.
Sure.
Yeah.
I'm interested in Nike's report as well after the bell. And isn't there another big name? Is it FedEx that's reporting tonight? I have to go look it up, but I thought there were a couple that grabbed my attention, but Nike was.
I'll hurry and look. The one I was looking at was Nike this morning, but I'll hurry and look.
All right. A couple of quick other news items. Then I'm looking forward to today's round of buy one, hold one, and dump one. Coach Greg's going to be highlighting 3 stocks from the retail sector: TJ Maxx, Ross Stores, and Target. Also, we call Target here at Tackle Trading, Greg. But we're going to be taking a look at those 3 companies and playing that round of buy one, hold one, dump one here in just a minute. But a couple of other quick news items. Tyler, you even mentioned this morning, Eli Lilly, is picking up, some of the healthcare and biotech type names, any ETFs that it's in, because it actually got emergency approval and breakthrough not emergency approval. Let me clarify that. A breakthrough therapy designation from the FDA that leads the path to potential approval, those kind of things. This is on the back of just a few weeks ago where Eli Lilly got swept up with that Biogen news as well, where they had Alzheimer's drug approval. Tyler, the stock's gapping out here. What's your read on Eli Lilly? Number one, I don't think there's any trade here, but in general, you were watching the XBI as well and seeing some pickup. What's your read here on this space?
Real quick, is breakthrough therapy, is that a technical term on the path to getting approved? Or is that just hey, attaboy, Timmy, what a breakthrough performance?
No, given it the label from the FDA has to come from a panel, I believe, to vote for that.
So that's one of their official terms is breakthrough therapy.
Yeah, from what I understand, yes.
Okay.
From what I understand.
Chart looks great. I mean, this has been so news driven. This kind of illustrates the difficulty of trading a drug stock. What was more interesting to me is you're seeing whether on the backs of this or just getting caught up with the whole return to growth related names and tech stocks. Biotech doing a little better. So this chart is XBI just perking up a little bit here, testing resistance, came off of it a little bit, but just coming around with the growth area. This chart kind of looks like the ARC chart where it fell out of favor in February and starting to make a little bit of a comeback. So I like the constructive nature of its turnaround attempt.
Yeah, I agree. And it does feel like that ARC innovation type of chart. And you mentioned that yesterday, especially when we were looking at Tesla as a potential breakout. And even in pre-production, Tyler, you were highlighting the fact that ARC was, having such a nice little performance and rotation back here. Anything you want to add to your thoughts on the ARC type of stocks in this area of the market?
Just that I think it's a good barometer to watch. I feel like and maybe this is just because of the type of environment we're in. Maybe this will go away as being a good proxy. But right now, I feel like this has been a good barometer to track for how the market feels, about momentum stocks, growth stocks. And the market feels a little different this week, I think, in part because this thing is now trending higher. So getting a little bit extended here, but I prefer markets. I prefer, let's say that way. Yeah, I prefer markets. They're easier to trade, I feel like, when this thing's in an uptrend. You could say the same thing about the NASDAQ, but the NASDAQ is more heavily weighted towards mega cap stocks. This, I think, is broader representation, more of the smaller caps, the probably less good fundamentals. I don't know why I said less good, but they have poor fundamentals. So when the traders only go after those stocks when they feel good, when they're optimistic. So it's just a sign of the optimism underneath the surface.
Yeah, I think you're seeing some of that obviously pick back up, and some of these names have been some of the top performers over the last couple of weeks. So we'll see if that continues. They're going to be fighting some resistance right there on that chart, obviously. So we'll keep watching. All right, guys, that's what I got from the news perspective. If anybody else has any other news items, absolutely bring them in here. But we are going to be transitioning to our last segment here today, which is the weekly edition of Buy One, Hold One, and Dump One, where Coach Greg finds 3 fundamental companies, and which ones he loves or doesn't. He doesn't tell us that. He lays out kind of the data and the detail behind them, what they're doing from a balance sheet perspective, a dividend perspective, payout ratio perspective, lays out the argument. And then as coaches, we get to decide which one we would buy, which one we would hold, and which one we would dump. Greg, I'm interested in today's segment, retail, man. What you got here today? TJ Maxx, Ross Stores, and Target is what I heard from your pre-production. Now, where we're starting from?
Yeah, so I looked at discretionary today. If you bring up that ETF for me there, Ty, it's been running recently. It's trying to get back to those highs there, that 180 zone there. So nice extended run the last couple of weeks or so. Maybe 3 weeks there. So I thought, it's showing a little bit of strength, above that 50 MA, just chugging along. I just liked where the action was going for that, even after this pullback, back in May there. So looked at that and I thought, okay, well, let's see what's in there. I looked at all the holdings and tried to put them together. And that's where I came up with 3 retail. So they call them specialty retail. So I wanted to kind of put 3 together that people would recognize and kind of have an idea of who they are, and maybe just a little bit understanding from a personal standpoint of these companies. So TJ Maxx, Target, and Ross Stores, all retailers in the States, I believe. Like I said, kind of household names. At least I'm a Canadian and I know of all of them. So I'm assuming that our friends in the States do as well. So if we look at Target first, I'll run down some data here. I sent it to Tyler there. He'll put it up after we're done. So there's going to be a couple of caveats here that I'll get into when I get into the last 2 picks here, but we'll go through Target. So Target's it's a higher dollar stock. It's 230 some odd dollars. Was 230. So let's say 239 now. It was 237 when I looked at it today. So good on it. So looking at that, it's expensive stock, but it's a quality company that everybody knows. You've got that brand loyalty there, right? So their dividend is about 1.52% right now. They've got 49 years, almost 50 years of consecutive dividend increases, which is quite impressive. They started paying dividends in 1965. Now they have a paltry 22% payout ratio, which means they're only paying 22% of their earnings out in dividends, which means they've got a lot of room if they ever wanted to raise their dividends, which, as you can see, they've been doing quite well for a long time. The PE ratio that I found was around 19. And we start looking at their fundamentals, their strong fundamentals. Assets versus liabilities, total assets of about 51.2 billion, total liabilities of 36.8 billion. So a fair bit of extra there to continue working in the company there. They have around 8 billion in free cash flow, and they have 4 years of consecutive increasing net income. So 4 years in a row, their income has gone up, which is a quality metric for sure. And then just looking at sales growth, if you look at the chart itself, as you can see, it's been kind of running for a while now. Got a real nice channeling action here, just a juggernaut really, and quality companies tend to do that some of the time. So like I said, metrics wise, their sales growth this year is around 45%, and they're expecting. Sorry, I apologize, wrong one. Their sales growth this year was 8.8%, and they're expecting a sales growth of next year of 2%.
Okay.
So that's how Target looks. So let's go to TJ Maxx as the next one. TJX. So a little different chart here, right? Had a pullback, showing some strength, got some overhead resistance there. You can see you got the 50 MA in play there. You've got an old resistance level just before you hit that as well. So could be some challenges here. Kind of stuck that landing at the 200, which I thought was good, and then starting to work its way higher. I think there's potential here. If you can break that 50, obviously you've got to run up to 75 there. So I think there's a bit of potential for price appreciation here as well, and then we'll get into the metrics of it. So if we go and look at the metrics of TJ, so about a $66 stock, 1.58% for a dividend. Now, I have 0 years of consecutive dividend increases, but I have to qualify that. That's where the caveat comes in. So last year for both TJX and Ross stores, they cut their dividend in 2020. Okay, so pandemic year, you can either choose to include that or not include that. I personally looked at the data for the previous basically 20 years. They both had consecutive dividend increases every year. It was only the pandemic year where they pulled back. They've been back up to their numbers again this year. So take that with a grain of salt. But basically, by the numbers, they have 0 years of consecutive dividend increases. They started paying dividends in 1980. Their payout ratio is around 42%. Now, their PE ratio that I found, and again, please, these numbers are subject because you can find different ones everywhere. But I saw a PE ratio of 53.
Yeah,
So
me too.
A bit of a higher PE ratio there. Balance sheet wise, they had 30.8 billion in assets versus 24.9 in liabilities. They got just about 6.7 billion in free cash flow, and again, their years of consecutive net income increases is again 0 because 2020 was a year where their income pulled back. The 3 previous years to that they did increase. It's just 2020 kind of cut that short. Sales growth. Here's some sales growth numbers for you. 43.2% current year sales growth, and they're expecting 6.9 to 7% for next year's sales growth. So some pretty solid numbers for sales growth there.
Mm-hmm.
All right. And if we can look at Ross stores next. So very similar chart to what we saw in TJ Maxx. Took a bit of a beat down there, held up above that 200 MA, pushing its way back up to the 50, but obviously we know that can act as resistance. If it gets above there, again, I think you get a run back up to those highs there. So there is the potential there for a little bit of price appreciation. $120 stock, so about twice what TJ Maxx is. So you got three companies today with very different price tags, but all kind of in the same industry there. So numbers wise, it's going to look a lot like TJ Maxx. Your $120 stock. Their dividend payout is 0.94, so not quite 1%. Same scenario as TJ Maxx in the fact that they have no years of consecutive dividend increases because of the pullback or the clawback in their dividend in 2020. But if you take the data before that, it's just shy of 20 years of consecutive dividend increases there. They started paying dividends in 94. Their PE or their payout ratio, is 23%. So they got lots of room to up their dividends. They've got a PE ratio of 50. Now they're a bit of a smaller player here. They've got assets of 12.7 billion and liabilities of 9.4 billion. Their free cash flow is sitting at 3.6 billion, and again, 0 years of consecutive net income increases. Sales numbers wise, they had just under 45% this year, and they're expecting 7.7% next year. So very similar numbers to TJ Maxx.
All right. And then Tyler, I believe you kind of compiled, Greg compiled the data, gave it to you, and now we can kind of go through it a little bit one at a time. I'm looking at these three companies, obviously all in retail in some fashion, but one of them very different than the other two. Pretty obviously, Target is more that big box, brand type of retail type of company, where TJ Maxx and Ross Stores, discounted retailers, more of the clothing line type of companies alone, although Target does still obviously sell clothes, but that's not just all they do. So those two are more close to each other than Target. Tyler, what are you seeing in the data, and kind of walk us through it one more time as we can see it visually here, so we can think through this buy one, hold one, and dump one decision-making process.
Okay, and I think I got my mind made up as well. So, yeah, so just to recap so you can see the numbers that Greg was going through here. Target, most expensive stock from a price perspective. Dividend yields in the middle, 1.52. The dividend increase, I'm impressed. 49 years, that's pretty impressive. Started paying out in 1965. Now, I do math here. 1965 plus 49, 2014. Does that mean there was a couple years in there where they weren't increasing dividends?
Looks like in the late
takeaway?
60s or early 70s. Yeah. So from 1972, they've been increasing dividends, I believe.
Look, late 60s was a tough time for specialty retail. It's okay. It's okay. 22% payout ratio. I like that. Lowest of all three. So they got plenty of money to increase the dividend per Greg's comments. 19 PE ratio, 8.8 sales growth, 2%. Next year, assets liabilities, 51 bill versus 36 billion. 7.9 free cash flow. That's billion. And then 4 years of increasing consecutive net income. That means they increased their net income last year, correct, Greg?
Yes.
If I was Target, I'd be like, what pandemic? Look, man, we still increased our net income during the pandemic.
Well,
That's
you remember,
impressive.
I mean, here on the halftime report, Matt and I talked about Target quite a bit through the last 15 months. Very popular company. Also on one of our lists, as well, on the Tackle 25 Poor Boy Covered Call list. But they had really, really good metrics and numbers around online sales, deliveries, pickup, all that kind of stuff. I mean, they really did. They were already moving that direction. This whole industry was in many ways, but Target really, took advantage and capitalized on the dynamics, and, really, really did a good job building revenue through those outlets. Yeah.
It will take more than a pandemic to keep the modern day housewife away from Target.
That's true.
That we know.
Although I love Target too, so I don't think it's just housewives, but I get the point. I think that's Tyler talking his book right there. But I love Target, so all right, a great one here. What about the other two here, Ty?
So TJ Maxx, $65 stock, highest dividend yield of the three. Although it's paying more of its earnings out in dividends than the other two. So there's reason for that. 53 PE ratio, which I suspect is just a byproduct of stock price has gone bananas in the wake of the pandemic, and earnings simply have not gone up as much, right? Sales growth really good this year, which tells me it's because it was coming from a low base last year. And then you get back to normal starting next year, 6.9%, probably more typical. Assets, more assets than liabilities. Ratio looks kind of similar than the previous one, if I'm eyeballing it here. Maybe a little worse, actually. But regardless, free cash flow of 6.7 billion. And then your asterisk there is the 2020 was. What did you say it was before? If you
so the three previous years, yeah. So 17, 18, 19, they increased their net income.
Okay.
2020, they dropped it. Now, again, just speculation on my part. I don't know how the opening was affected, whether Target being a big box store was allowed to be open, and maybe the TJ and Ross stores were closed at some point. I don't really. I know here in Canada we had some of that, like the clothing stores, just the straight clothing stores were shuttered for a while, whereas the big box stores were allowed to be open. So that could have affected it. But yeah, that's what I'm seeing is the net income with the three previous years was increasing. It's just that 2020 number hampered both of those. That's why I've got that asterisk beside it.
You know what TJ Maxx should have done? I don't know about the Targets here in Utah. They got a little grocery section.
Mm-hmm.
Some of these retailers just should have put a little grocery section in the front corner.
Should have bought a bag of oranges and put up a little table, and there you go.
Hey, what?
For a grocery
People need
store.
food. We should stay open. Yeah. All right. Ross Stores, $120. Dividend yield 0.94%. It is not paying as much of its earnings out in dividends. PE ratio 50. Big sales growth, which again, coming from the low base last year, that's returning to normal, and then going out next year, 7.7%. 12.7 assets versus 9.4 billion in liabilities, 3.6 billion in cash flow, free cash flow. And how many years was, if you don't count?
Same 3 years. Yeah.
Okay.
Yeah.
All right. Tim, you want me to go first, or you locked in?
I'm locked in on the one 1,000%. But the other two, I'm still kind of waffling on. You go first, young man.
Okay.
Let me hear what your thoughts are.
All right. Well, I think the easy choice would be Target. Okay. And the safe choice would be hold it because it's fantastic. But I'm going to go even further than that to express my enthusiasm for this company. And I'm going to say buy. I'm going to say buy Target for 2 or 3 reasons. Reason number one, they killed it last year, which is impressive because really, I think 2020 was a separating year between who has their crap together and who doesn't. I'm impressed by that in terms of their earnings performance. I mean, look at the PE ratio. Why is the PE ratio so low? I mean, in today's context, a 19 PE ratio is pretty low. Somebody check real quick for me what the S&P 500 PE ratio is. I don't think it's 19. I'm pretty sure it's more than that.
I think it's a little higher than that. I'll look.
The Schiller PE ratio is like 34.
What do you know what the trailing 12 months is?
12 months, probably around 21.
Okay, so you're getting this cheaper than the S&P, which is very, very impressive given how much the dang stock has gone up, right? For Target to be able to go from 100 to 240 in a year and still have such a low PE ratio tells you something about how impressive their earnings growth has been, right? So it's not as if I'm overpaying from a valuation perspective. That I think is impressive. They almost have the highest dividend yield. They don't by whatever that is, 0.6%, or I don't know if I said that right, but you get it. But they're only paying out 22%, whereas TJX, to beat them on the dividend yield front, has to pay almost half their earnings out in dividends. That I find impressive. I don't care about the sales growth and next year being lower. Whatever, they're killing it. I don't care about that. All that said, plus the chart, plus the history. Come on, man. What's not to like? So Target is the obvious buy for me. So then it comes.
Yeah, go ahead.
Then it comes down to the other two, right? Which one do you hold? Which one do you sell? And so it's easier to just say, well, what do I like least in regards to these two? On the fundamental front, I don't know that there's anything major that jumps out at me that I don't like about either one. I mean, if I have to cherry pick, I'd say, I don't know, I like that this one has a better dividend yield. But then you come back and say, well, yeah, that's because 40% of their earnings comes out as dividends. So for me, it's 6s on the fundamentals. Then I just have to go to the chart and I say, okay, TJX is a little bit messier. Ross has a pretty good chart. I think it's slightly better, and my wife shops at Ross and loves it. So I'm going with Ross as the buy, TJX as the sell.
Interesting. So you had Target as your buy.
Hold. So I'll hold Ross. I'll buy Target, and I'll sell TJX.
Gotcha. All right, Matt, you want to go next? Or you want me to go next?
I'll go last.
All right, let me think through this. Here's the thing. Can I buy and hold Target and sell the other two? Can I just change
that's what I was doing.
I'm going to do that. I don't want the other two. I'm not that interested. If I have to play the game based on the metrics, and we can change whatever we want, but because it's our game, we get to make up the rules, Greg. I'm buying Target again. It is a clear leader out of these three. There's no question about it. They survived a punch in the nose like all companies did during the pandemic. They came out of it not only ahead. The 2% sales growth is actually not a negative to me for next year. I see that as a positive. After the sales growth they had this year, the size of the company they are, that they're still projecting growth the year after that.
To maintain.
to norm. I think that's a great thing. They've got a really good valuation relative to the marketplace. I know the fundamentals are sound. It's on the poor boy covered call tackle 25 list. I'm looking across the metrics. P ratios looking good. Sales increases are looking good. Earnings per share, guys, we're up almost 30% year over year from 2020 to 21 in the last 4 quarters fiscally. So I'm impressed. I love Target. I think you can continue to buy that one. So I'm with you, Ty. I'm going to buy that one. I actually am reading those charts different than you are, young man. I like TJX better on a chart. I'm going to say hold TJX. And the reason I'm seeing it a little bit different is its support right now is testing against an old resistance zone on the long-term charts and some key moving averages. They're so subtly different. They're not a huge difference in the two, so it's really going to come down to the eye of the beholder. But here's one other fundamental metric that did, Ty. All the numbers look very similar. They both got share buyback programs. They both took a hit in the pandemic. Their free cash flow relative to how much their market cap is actually pretty similar to each other, quite frankly. TJX has a lower PE ratio and a lower PEG by just a little bit. So as a tiebreaker, I'm going there, and I like that old resistance play and his new support. So for Tim, I am selling Ross, holding TJX, and easy buy on Target. Matt, what about you?
Yeah, I'm similar, Tim. Target would be a tackle 25, but it was so good it went up so high. That's how good Target is. So I'm going to buy. I'm going to hold. However you want to categorize Target, it's definitely 1A, 1B, 1C for me here in these 3. The other 2, I'm fundamentally 6s on them, like Tyler is. You can kind of lean one way or the other. I think they're going to run together. They're very similar to companies, but if I had to, I'd pick Ross over TJ Maxx. But it's, again, gun to head type scenario for me with those 2.
So Matt would be a buy on Target, then I'm hearing hold on Ross and a sell on TJX. So I was the only one that went a little different on those splits, but close. Greg, what did we miss, if anything, here? What was your take on it?
Yeah, so obviously, there's a chasm of difference between Target and these other 2, even though they are in the same space. So obviously, Target's not going to let you down. They've got years and years of consecutive dividend increases, which is right, in my wheelhouse. My only concern with Target is obviously the price tag. Right, if you're gonna be buying some shares of this and holding it to collect those dividends and whatnot, you're gonna be putting out some capital to do so. I prefer my dividend payers to have a little less sting in the pocketbook when I buy them, but understandable. Now you look at it from a PE ratio, and their price is perfectly in line with what they're doing, right? So no argument that way. Understandable. I love all the metrics of all 3 companies, really. Assets versus liabilities. At the end of the day, when you get a company that can pay dividends increasing for, in the case of Target, 49 years, and in case of those other 2 with that asterisk, 20 years or, almost 20 years, and yet still have, way more assets than they have liabilities, that to me shows stability, because we've really gone through some stuff in the last 20 years as well. So I think that's important to think about. I love the free cash flow aspect of all 3 of these companies. They are different sizes, obviously. But sitting on billions is not a bad idea, just in case we do run into some tough economic times, right? So I do like that. And again, I give these 2 other companies, TJ Maxx and Ross, I give them a pass for the pandemic. The fact that they cut their dividend for that 1 year, the fact that they're already back to pre-pandemic levels from the dividend for this year, makes me feel that they're going to do okay. So again, yeah, everybody took it on the chin, pandemic. Target was able to ride through it. Again, I kind of spouted off about why I think that is. But at the end of the day, I would hold Target. I'm actually interested in buying TJ Maxx. I do like the dividends, the 1.58%. It is the highest, not by a lot, obviously. The fact that they've got, like I said, with the asterisks, almost 20 years of consecutive dividend increases, that still shows me stability. But for me, it comes down to the price tag. I can buy 2 TJXs for basically 1 Ross. And really the numbers are very, very similar. Growth numbers are very similar. Free cash flow, everything's very similar. Yeah, their payout ratio is a little bit higher, but I'm really not concerned about that. That 42% from a payout ratio for me means absolutely nothing. If they were up around 70, 80%, then that would be a conversation I have. They still have lots of room where they can continue to increase their dividends. So that's not really an issue for me. But the other part to that is, and I guess this is the kicker for me, and I know I'm kind of bringing in another little metric here, but these are the things that I think about, is if I buy TJ Maxx and I buy 2 of those for every one that I could Ross, I can turn around and sell covered calls, and the covered calls on TJ Maxx are actually quite juicy. They're decent for the type of fundamental stock that they are. So that's when I kind of go to the price tag and I think, okay, how many shares can I acquire for? Let's say I've got a $20,000 stake that I want to put into a stock. I can look and say, okay, how many of each share can I get? How can I create even more cash flow beyond the dividend? And that's really the tiebreaker for me, because rest of the metrics are so similar, right? Their sales growth is right par with one another. From a billions perspective, they're all within line each other too. So that's where I stand. I would hold the target because I love the stability of it. I would buy the TJ Maxx because I think I can create some cash flow on a still pretty fundamentally strong company, and then I would dump Ross just because I got to play the game.
Fair enough. Pretty close to what we all said, though, besides the hold versus the buy on target. I think you're more probably just because of the price tag. You like getting those little lower price tag stocks for your buys. But got it. Loved the conversation here today, guys. And Greg, 3 stocks from retail as an interesting one to highlight. So thank you very much for doing that. All right, guys, let's start moving in towards the back end of our show here and start wrapping it up here on a Thursday. Back on the S&P 500. Ty, and let's get some final thoughts. Start with you, Greg, actually. Final thoughts on the market as we're closing up Thursday.
Yeah, I think we nailed it in the get up from the start there. You're getting that rotation. Things are looking good from a growth perspective. I don't see that stopping until it does, kind of thing. We are at a point here where the S&P 500, it's trying to break out of where that is that double top there. It did reach to an all-time high. I think you got to pay attention to that, right? If we get a little bit more legs out there, you can get another run up to another level. But right now, I'm not super convinced on the breakout just yet. I think we're still in the same wheelhouse there, but I do like the strength that it's been showing recently. So,
Matt and Tyler, let's bring you guys in. Matt, you first. Final thoughts from you, sir.
Final thoughts. I'm very interested in the market over the next few days coming into the weekend, how it really, as it takes a little bit of time to digest what is happening today from a political perspective, if it changes at all how we see the sectors right now coming into the weekend. I'm very interested in that. I think there's some open questions right now. There's some quick take analysis, but I do think giving the market a little bit of time to digest this news is going to be fairly important.
Yeah, it's going to be interesting to watch those price responses as well. We had a little bit of a bump there intraday when the news got broke. Tyler, what about you? Final thoughts, sir?
Oh, I have 2 things. The first thing is I feel like financials and commodities heard us talking smack and showering affection on growth. And they're like, nuh-uh. And financials are now up 1.23% on the day. Well done. You've also got metal and mining stocks almost up 3%. You now have the Dow up more than the NASDAQ. I'm totally reading too much into short-term price action here, but it supports what I wanted to say, so I don't care. I like it. I like. They are making a little bit of comeback in continuation of what Matt said with the Dow playing a little bit of catch up here. So, well done.
Going to be that's going to be what we watch here today, tomorrow, the next few days as we keep an eye on price responses. All right, guys, that's it for our show here Thursday, 6/24/2021. If you're out there watching, conversation was great here today. Appreciate you guys going back and forth. Always great to see Coach Frank out there in the chat. And if you're not following Coach Frank on Twitter. Make sure that you do that at Tackle Trading on Twitter. Puts a lot of great charts out there, and he'll be with us tomorrow to highlight some of those charts as well in our Friday Fun Day, where Coach Frank always joins us to round out the week. Have a wonderful rest of your day. Pro members, Cash Flow Club is tonight, 8:30 p.m. Eastern. Do not miss that one. That is our weekly webinar where we highlight cash flow tactics and techniques. Make sure you come and find us on the events page at Tackle Trading. Guys, we're out for today.